All right, let's talk about a huge milestone, investing your very first $10,000. We're going to forget all the hype and just break down a simple, repeatable system that actually works. This is your plan for building real wealth. There's a reason everyone says this, and it's because it is 100% true. Your first 10K is the hardest and the most important. Seriously, getting over this one hill, it changes the entire game. So to get you there, here's our roadmap for today. First, we'll get into why this $10,000 milestone is such a big deal. Then, we'll cover the absolute must-dos before you invest a penny. After that, we'll map out your path to 10K, lay down the rules of the road to protect your money, and finally, look at how to keep that momentum going. Ready? Let's jump in.
First up, why does this first 10 grand even matter so much? And honestly, the subtitle says it all. It's not just a number, it's a real turning point. See, this is the real secret. It's not really about the money itself. Hitting that number proves to you that you've got the discipline. It's a mental breakthrough. It's that moment when the light bulb goes off and bigger goals, like $50,000 or $100,000, suddenly feel totally possible, inevitable even. And here's the math behind the magic, the incredible power of compounding. That first 10,000, just sitting there earning a pretty average 7% return, almost doubles to nearly 20 grand in 10 years. Okay, cool. But wait 20 years, now it's pushing 40,000. In 30 years, you're looking at over $76,000 from that original investment. That first chunk of cash is the seed, and time is the best fertilizer on earth.
All right, let's get into our foundation checklist. Think of these as the absolute non-negotiables. You've got to have these things sorted out before you invest a single dollar.
So think of this like a pilot's pre-flight check. First, you need an emergency fund. I'm serious, do not skip this. Get 3 to 6 months of your living expenses stashed in a savings account you can get to easily. That's your safety net. Second, go after high-interest debt like a predator. Credit card debt at 20% interest will absolutely destroy any gains you make in the market. Pay it off. Third, only invest money you won't need for at least 3 to 5 years. The market's going to go up, it's going to go down, you need time on your side. And last, open the right kind of account. Look for a brokerage with low fees or even 0 fees and no account minimum.
Okay, foundation is set. Now we get to the main event, your path to 10K. This is where we actually lay out the plan and pick a strategy that works for you. So, the million-dollar question, or the $10,000 question, I guess. How long is this actually going to take? Well, this chart breaks it all down pretty clearly. Let's assume a 7% return. If you put in $100 a month, you will hit that goal in about 6.5 years. Not bad. But if you can double that to $200 a month, you slash the time to just 3.5 years. And if you can find $500 a month, you're there in about a year and a half. The key takeaway here isn't the dollar amount, it's the consistency. The habit is way more important than the amount.
Now, what's really cool is there isn't just one way to do this. It's kind of like a choose-your-own-adventure for your money. We've got 4 main paths. There's the index fund highway, which is perfect for the set-it-and-forget-it type. There's dividend growth, for people who want to see some regular income. Then you've got growth stocks, for those who are okay with a bit more risk. And finally, the hybrid approach, which kind of balances everything out. Let's talk about path 1, which is what most experts recommend for beginners. Index funds. All an index fund is a giant basket of stocks that just copies a market index, like the S&P 500. It's the core of the whole Bogleheads philosophy. And why is it so great? Well, you get instant diversification across hundreds of companies. The fees are dirt cheap, and it is just so simple to manage. Path 2 is all about dividend growth. Some people absolutely love this approach because you get tangible rewards along the way. Big companies pay you a little slice of their profits. That's a dividend. And if you set up what's called a DRIP, a dividend reinvestment plan, those payments automatically buy you more shares of the stock. This creates that famous compounding snowball effect. Your shares make dividends, which buy more shares, which then make even more dividends. It's a huge psychological boost. So, which path do we usually recommend for beginners? It's path 4, the hybrid approach. This chart gives you a pretty good idea of what a balanced portfolio looks like. The core, a big 60% slice, is in those safe, boring, broad market index funds. Then you can add 20% in dividend funds for that income stream. Maybe you take 10% and put it into a few specific growth stocks you really believe in, and you keep the last 10% in cash or bonds just for stability. It really gives you the best of all worlds. All right, you've got your strategy picked out. Now let's talk about the rules of the road. These are the simple, powerful principles that are going to protect your investment from its single biggest enemy, which is usually you. Rule number 1. This is the big one. Automate your investments. Every month, every paycheck, whatever it is, set up that recurring transfer and then forget about it. This strategy has a name. It's called dollar cost averaging. It just means by investing the same amount regularly, you automatically buy more shares when prices are low and fewer when they're high. It smooths out the ride. And that leads right into maybe the most famous saying in all of investing: time in the market beats timing the market. Trying to guess when to jump in and out is a fool's errand. In fact, Vanguard did a study that showed if you missed just the 10 best days in the stock market over the past few decades, your returns would have been cut by more than half. Just stay in. And to really drive this point home, here are the biggest mistakes you have to avoid. Ready? Don't wait for the perfect time. Don't panic sell when things get scary. Don't chase meme stocks. Don't spread tiny amounts of money across 100 different things. Don't spend your profits before you hit your goal. And please, don't ignore taxes. Just avoiding these few things puts you ahead of 90% of beginners. So, you're on the path. You're following the rules. Great. But let's look beyond that first 10K. Let's talk about building real momentum, how to get there faster, and what happens next. So, you want to speed things up? Here are some simple tactics. The number one thing: increase your income and invest the difference. Got a tax refund or a work bonus? That's investment money now. Go through your bank statement and kill all those subscriptions you forgot about. Sell stuff you don't use anymore. And this is a huge one. If your job offers a 401k match, you have to contribute enough to get the full match. It is literally free money. Don't leave it on the table. Look, we can break this whole thing down into a really simple timeline. Month 1, you open the account, pick your monthly amount, and you make your first investment, even if it's just $10. Months 2 through 6, you automate everything and do a quick check-in once a month. By year 1, you're looking for extra cash to throw at your goal. And then from year on out, you just stay consistent. The habit becomes automatic, and you'll blow right past that $10,000 mark before you know it. And this is the best part. After you hit that first 10K, compounding really starts doing more of the work for you. The habits you built get you there, but then your money starts making real money all by itself. It makes the journey to 20,000 and then 50,000 feel so much faster. The snowball is officially rolling downhill. I really want to end with this idea because it's about more than just numbers in an account. When you have 10K invested, you're a different person. You know how it's done. You've proven it to yourself. You've built a system, you've got the discipline, you've basically unlocked a new level of financial confidence. So look, the most important step is the first one. Let's make a public commitment right now. What's your monthly contribution going to be? Drop that number in the comments below. Let's make it real and get you started on the path to your first and most important $10,000.